Welcome to the Passive Mobile Home Park Investing Podcast with your host, Andrew Keel. This is the podcast where you can get the education you need to invest 100% passively in the highly profitable niche of mobile home parks.
Welcome to the Passive Mobile Home Park Investing Podcast. This is your host, Andrew Keel. And today we have an amazing guest in Mr. Skyler Liechty. Skyler is a third-generation mobile home park owner and a founding member of American Dream Communities. During his career, he has overseen numerous types of mobile home communities, including stabilized, turnaround, and value-add opportunities. He has held manufactured housing retailer licenses, broker licenses, installer licenses in Texas, Oklahoma, Missouri, and Kentucky. Skyler has owned communities in Texas, Missouri, Oklahoma, Kentucky, and Kansas with a total pad count of nearly 5,000 spaces. Wow. The portfolio is currently comprised of over 2,000 home sites, placing it in the top 100 of park owners in North America. The most recent American Dream Communities fund was a $15 million equity fund. Wow. Skyler, thank you so much for coming on the show.
Thank you for having me, Andrew. I really appreciate this opportunity.
Wonderful. Let's jump right in here and get started with the questions. Would you mind starting out by telling our listeners a little bit about your background and, how you got into manufactured housing?
Sure, absolutely. So as you mentioned in my introduction, I'm a third generation mobile home park owner and operator. I acquired my first community in 2001, 2002. We kind of started in our path within the family. And in 2009, when we formed American Dream Communities, that was kind of the movement outside of the family portfolio into more institutional type syndication assets.
Awesome. And I just wanted to chat with you a little bit about this because, not many mobile home park operators had a business back in 2008, 2009. And
Right.
Could you tell us a little bit about that time and the recession resistant, or
Sure.
non-characteristics you saw at that time in this asset class?
Sure. So I think like anything, Andrew, it's one of those things where depending on what region you're in, what market, those are going to impact communities differently. Our communities, through 08, 09, we really didn't see much of a hiccup, collections as with this COVID situation remained relatively stable. We had a couple of move outs. We went out and did what we do now, bought new homes, replaced those lots, resold or released those homes. So again, I think it's one of those things that the guys and gals in the industry who are paying attention knew what they had to do, tended to go through the recession fairly well. I think it'll be the same thing here with COVID. The guys and gals paying attention and know what to do, they'll do just fine in this asset class.
Awesome. Tell us, Skyler, what is the hardest part about this business in your eyes?
So I'll tell you, it's interesting because we were chatting about this right before we went into the interview here. It's in our judgment and in my judgment, the hardest thing is finding the right people. You got to have the right people for our corporate team, for our on-site team, whether we want to admit it or not, whether we like it or not, we're in the people business.
Yep.
Whether it's working with our team, whether it's working with our residents, our vendors. I mean, that's just really what it is. So what's interesting is kind of the flip side of that equation is once you have the right team in place, I mean, it's amazing because you could do things you really didn't think you could do when everyone's flowing together. I mean, you could just sit back and kind of say, wow, this is how it's supposed to be type of deal.
Totally. And so do you guys have your own management company?
Yeah, we do. So our management company, we manage the deals we own, and then we also have a third-party management platform. So that's something that we're pretty selective on who we manage for. We really feel like on our third-party platform, we want to be good partners to the people that we're managing their asset. Everyone has a different viewpoint of how the asset should run, how it should be managed. So for the groups out there that we manage, we're really good partners with, because it's the same vision. It's a shared vision. So yeah, we do both. We manage our own assets, and then we do third party management as well.
Wonderful, wonderful. And tell me, Skyler, what does the perfect community look like in your eyes? And what do the communities look like that you prefer to manage?
Okay, great question. So, there's kind of a two-part question, right? So one, what's a perfect asset? It's 100% occupied, 55 plus retirement community in Florida, just picture perfect, no tenant issues ever. So that's what the ideal community looks like. Now, what that also means is it's very challenging to get a current yield when you buy assets like that. Now, that it can be done, but it's a challenge. So I would say from a investor standpoint, from a yield standpoint, we're going to look at a good market. Maybe it's a primary, secondary market, big MSA. We're going to find an ugly park, or a park that's completely mismanaged. And those are the deals we want to buy. We want to put the right management policies into place. We want to fix what needs to be fixed. And that to us is something that a lot more challenging, but I think the rewards are a lot bigger on those type of projects.
Totally. And this may be, market specific, but what cap rate, do you look to pay on those primary market kind of mismanaged assets?
Yeah, good question. So when we look at a cap rate, I think a lot of times people maybe don't fully appreciate, as you and I and the other investors out there, a cap rate is supposed to be a reflection of the risk. So if you're buying a deal that has been mismanaged, you're gonna pay a different cap rate for it, because you got a different risk profile. The flip side of that also is, if you buy a property that is really mismanaged, maybe the owner doesn't keep up with the repairs, doesn't keep up with the market rent. In today's market, you may find on current numbers, you're buying an ultra low cap rate. So, for example, we bought a property in Tulsa, Oklahoma. It was a little over 100 unit park. There were about 35 vacant home sites in it. And what we were able to do is go in, do the repairs, and fill up the vacant home sites, and take that asset from, call it, mid 200 lot rent up to about 400 lot rent, which is a market rent. So for us, that was a really good illustration of the deals we look for. So the current cap rate on that, I think we paid a 2 cap, but it really didn't matter, because you when you step back and look at what the asset had the potential of being, that's kind of how we underwrite it as well. So it's not just always, hey, going in, we're going to buy a 7 cap on current income. Stabilized deals, full market, full boat. You're probably today's market, depending on what market you go into, call it 4 to a 6 cap in a major market.
Great. Yeah. Thank you for sharing that. Yeah. So you put a lot of value up front on, what it's going to be, post the rehab, post the renovation work and improvements.
Right.
Okay. Very cool.
Yeah.
So as we talked about, prior to this recording, a lot of our listeners are passive investors in other asset classes, multifamily, self-storage, et cetera. So what are the most important things you think that those passive investors need to look out for when investing into mobile home parks? What are those big risks that, that they should be aware of if they're not familiar with the asset class entirely?
Right. Good point. So I think the first thing is, probably like any investment, you want to be comfortable with the sponsor. You want to make sure that they've done it before. You want to make sure that they're invested in the deal. You want to make sure that they're willing to do the industry normal stuff, such as, if you buy a project that's going to require a lot of fill, those homes mean you're going to have to sign on full recourse debt. So sponsors who aren't willing to do it, don't invest in their own deal, have no track record, doesn't make it a bad deal, doesn't make them an incapable sponsor. It just, those are the things I think the limited partners really should look into. I think that's a really big key to it. simply, we've seen deals out there and guys who say, hey, we can do 30, 40, 50 home sites. We can fill 50 home sites a year. And while they may be able to do that, industry data out there doesn't support something like that. So I think the more seasoned sponsors are going to put out projections that are closer to reality.
Yeah, that's an interesting point that I'd like to talk a little bit more about. When you guys bring in homes for infill, I mean, on all of our previous interviews, everybody has said that infill is like the toughest part of the business. Like it's the most labor-intensive, time-intensive process in terms of any sort of value add, right? Mm-hmm. And the easiest is raising rents, to market.
Yes.
So with the infill process, do you guys prefer new homes? Have you ever done used homes? And, what are some of your tips or maybe just overall feelings on that process, for investors so they're aware of what's involved?
Yeah. So good question. So I think everyone knows really in this asset class, there's primarily two ways that you can increase valuations. One is infill. The second is raising rents. We've done well at projects doing both sides of it. We're a little bit different in our when we buy an asset that's a pure rent escalation play. We look at it and we say, okay, what's wrong with this community that we can fix, right? Because I think most people don't mind paying market lot rent if the community looks the way it should look, right? So we bought a property here in Texas last year. We went in, it was about $200 under market rent. We went in, we spent about $300,000 on streets, put in a new playground, fixed all the stuff that needed to be fixed. We did a very large rent increase, and most of the people said thank you. So which is different because if you go in and you just say, hey, we're gonna crank rents to market and we're gonna put no capital back in, I don't know that you'll get the same response from your residents.
Yeah.
So
totally agree with you.
On the fill side of things, that's absolutely correct. That is one of the most challenging value add propositions, simply because when you buy a home, you bring it in. So for us, it's all new homes. We've gone down the used home route. Truthfully, I think that's a fool's errand to try and source a bunch of used homes. Sourcing one or two for a park, no problem. But what we consistently found when we tried to source used homes is by the time you buy it, move it in, rehab it, you're within about 15% of the new home. And it's a lot more brain damage trying to source them, fix them, go through that whole process compared to buying a new home. The other side of that is, kind of as we've talked about with the value add, when you're moving in brand new homes, the rest of the residents view that as a shot of lifeblood into the community. They view that as, okay, someone's really sitting up, paying attention. They want to bring this community back to a nice, great place to live. So there's a lot of benefits with going in with the new homes compared to the used homes. But yeah, it's definitely a challenging piece of it. When you buy the new homes, you bring them in, you don't know how long it's going to take to deck them and put on skirting and all those components. You don't know if the city's going to change the rules on you, which has happened to us. We brought in, 15 new homes to the community, and they said, well, our setbacks are actually X. We said, well, wait. During diligence, we got it in writing. It's this. They said, well, they misunderstood. So you got to comply to this. So you got all sorts of unknowns. But the flip side of that is a huge value creation if you can pull it off.
Totally. Yeah, totally agree with you there. So you guys currently have a fund, right?
Correct.
Would you mind sharing a little bit about that and kind of what your outlook or business plan is through your current fund?
Yeah, sure. So all of our funds, we're wrapping up our second fund right now. We anticipate launching a third fund probably by the end of this year or first of next year. All of our funds are a 10-year time horizon. The difference of our fund and some of the other funds out there, I'm not saying theirs is bad. I'm just saying ours is different. For our limited partners, they get a 7% preferred return on all their dollars that go in. Of the cash flow, 100% goes back as a return of capital. So, meaning as the sponsor and as the GP, we have a management fee in place and some other fees as far as acquisition fee, disposition fee, the typical things there. But from a profit center, there's no profit to the GP until 100% of the equity is paid back at the fund level. Meaning we have eight communities in a fund. We don't just say, oh, we paid back equity on deal number one. Now we get half of the cash flow. It's at a fund level, which is different than a lot of the guys out there that are doing funds. And then after that, it's a 50-50 cash flow split, and then it's 50-50 on the upside. So
that's great.
So again, like our thought process is this: if we get into deals, we hope they're going to go the right way. Most of them have gone the right way because we have the right partners, we have the right structure. If the economy just tanks, as it has been, right, and the deals go the wrong way, what's the worst case? The worst case scenario is our limited partners lose money. So we've really structured this deal to try and get everyone's equity back as quickly as possible. So that's done through cash flow, that's done through refinances. So some of our deals are big value adds. So we can move the needle pretty quick in a period of time, go from a bridge to a permanent debt situation and do a cash out there once they're stabilized.
Great. Yeah. There's a pretty similar model across the board that a lot of operators use, including myself, the buy, fix up, and refinance model. So, but yeah, no, those seem very competitive, your terms of your fund there. Quick question before I forget, what is your thoughts on the park-owned home model versus the tenant-owned home model?
So I think if you could buy a park with all park-owned homes, you're going to have less turnover. Your expenses are going to be more stabilized if they're all, tenant-owned homes. Whenever you get into the park-owned homes, your expenses look different. You have some up and down in the revenue. But I think the reality is there's very few parks out there that are all tenant-owned homes. I think the reality in our industry is there's park-owned home components. Now, I think there's a difference between buying a park that's 30-35% park-owned home compared to buying one that's 100% park-owned home. Mm-hmm. That to me starts feeling very much like a hybrid of an apartment complex. So I think that model is different. That's not really a model that we've dabbled in. We tend to like to buy deals kind of on the outside at 40 to 45% park-owned homes. And then what we do is we'll go in, we'll try and convert those to people to have home ownership. So whether we can convert them from a rental to a lease to own model, whether we convert them from a rental into a consumer finance through some of the groups out there. The objective for us, and it's really how why we call our company American Dream Communities, is the American dream is home ownership. So our objective on the park-owned homes is to get people in a position to own as quickly as possible.
Yeah, that's great. And that's similar to what we do as well. Would you mind shedding a little bit of light on like your lease option program or what's worked for you on some of the communities that you've purchased in how you've converted those park-owned homes? Maybe you have some percentages. It's kind of like industry, I don't know if it's a myth, I guess, where they say, a third. Your park-owned homes, a third of them are going to want to stay rentals. A third of them will convert to a lease option or similar. And then a third of them will move out. Would you say that's accurate, or would you, say you've had different numbers?
Yeah. So I think that's a broad brush, right?
Yeah.
So what we have found in the communities we go in that have, for example, we bought a small community here in Texas, about 60 units. Of that, 45 were park-owned rentals, predominantly 80s and 90s vintage on the homes. When we went in, I think this is about 2 years of ownership now. I believe we've flipped about 75% of those. So we went in and pitched everyone on, hey, we want you to be homeowners, because that's what our objective is at a corporate level. Not many people. I think we had one or two of the 45 that signed up for it. The rest of them, when the end of their lease came up, they moved out. We made them ready. And all the new people we've put into a lease option. So I think for us, we've been very successful with vacant units, putting them into a lease option. The conversion from rental into a lease option. The reason I think that we have trouble, and I don't know if it's just that, maybe it's just us, I don't know, but a renter is a different mindset than someone who wants to own the home.
Yeah.
So it's a tough mindset conversion of, hey, your rental, you don't have to take care of any of the repairs at all, to we're going to convert you into a lease option where you're going to have some responsibility on repairs. You're going to have some responsibility on upkeep. So I think that's the biggest challenge that we've seen. And we've done it in Texas. We've done it in Missouri. We've done it in Kansas. We've done it in Oklahoma. So either it's us or it's the mindset of the renter compared to someone who wants to home own.
Yeah, no, I agree. We have parks across 11 states, and it's very, very similar across where we own. Is, just that mindset, like you were saying, they're not used to owning things. They're used to renting, and you just get a different outcome. Would you say, there's like a set percentage, or is it just variable depending on the park?
Yeah, it really is variable depending on the park. It may be a situation where you get more buy-in on the front end. And part of that, I believe, is also the ownership you buy it from. If you are buying it from an ownership that is treating everyone fairly, is trying to make improvements to the community, you will have more buy-in, right? Because the guy renting the home looks around and says, hey, community looks the right way. This is somewhere that I really want to stay. On the other hand, on the deals that are the heavy value adds, where you got infrastructure issues, you got tenant issues, you got all those things going on, even when you start doing the improvements, it's still a tough conversion, because someone who's willing to live in a C- asset, when you bring it up to a B+, it's a different tenant profile. Mm-hmm. So that's one of the things also. I think if you went into A or B community and it was a lot of rentals, you definitely are going to get more buy-in. Some of the senior parks in Florida, they have programs where they rent to the 55 plus, they rent it for a year, they convert them into ownership. And that's because that type of an asset, they're looking at, do I like the amenity package? Do I like the manager? Do they have the right events? So they want to try it, and they're eventually going to buy it. I don't know that translates over to the family parks the same way, though, or all age of parks, should I say.
Totally. Yeah. Yeah, I agree. With us, we make it very, very attractive to people that, when we come in and buy, and there's some park owned homes, just the path to ownership, kind of like you were mentioning earlier, we make it where it's like, it's a no brainer. We're not trying to get rich off selling these homes.
Right.
And I think once we kind of show them that, they kind of become more interested in it and interested in owning the homes. But yeah, it's very market specific. Like we had a park near Memphis that was completely different than a park in up near Grand Forks, North Dakota. So I think that's important. So quick question on you in your fund. Do you guys put money into your fund? Do you also sign recourse if that's required?
Yeah, good question. So in all of our funds, all of our pre-fund investments, we really started the evolution from a single entity asset. We had investors who said, hey, I want to be able to identify the park that I'm involved in, which that's worked out okay for us. The fund gives us the ability with the investors to smooth out the ride of the value adds, right? So we have some stabilized deals that produce a nice cash flow. And then we have the value add deals that, you could be 2 to 3 years with no cash flow because it's a huge lift job. So all of our deals we do invest in, every single one of the deals we have either recourse on the park, recourse on the homes. So I think recourse to us, we've become comfortable with that function of debt in this space. I think everyone would prefer the non-recourse debt on the park, but value add deals, I don't see how you can do that. So our
Yeah.
typical model on the value add has been a bridge to a permanent. So maybe it's a local bank, maybe it's a regional bank or a lender. They give us a couple year bridge. That gives us the time to go in, fix it, fill it, lease it, get rents to market, make it look the right way, and then go into the permanent market.
Great. Yeah. No, that's fantastic. I guess what's your plan for 10 years from now? What do you think that looks like, Skyler?
Yeah. So our internal objective is to grow to 10,000 spaces. It's going to take us a couple more funds, but that's where we're headed to. As far as an exit, I think our funds are structured on 10 years, and at the end of 10 years, I think we'll ask the limited partners what they want to do, if they want to sell everything or they want to ride along for a little bit longer. So we haven't fully defined in our minds what the 10-year exit plan looks like.
Gotcha. You mentioned a little bit earlier about the GP LP splits for your fund.
Right.
But would you mind just shedding a little bit of light on the typical fees, acquisition fee, dispo, property management, just what those look like and what they cover?
Yeah, sure. Absolutely. So on the acquisition fee, we charge 3 points of an acquisition fee. And that is a typical real estate brokerage commission. I shouldn't say typical because some brokers out there, they charge up to 10% of a commission. So the one thing that is predominantly different about our group is all of the deals we have bought to date have been off market. They've been principal to principal transactions. So those deals require, I'm not going to say more effort, but different effort. So we have deals that we've been working on buying for the last 15 years. This year is going to be the year that they come to fruition. Mm-hmm. So as far as the ongoing fees, 6% management fee, property management fee. There's a disposition fee, which is 3%. Other than that, we try and keep the fees skinny down, right? So acquisition and management, the way we look at it is within our fund, if we went into the on-market deals, there would be a potential commission to pay. If we outsource the third-party management, there would be a fee to pay. And from our point of view, I'm not exactly sure how a syndicator can outsource management and have the same grasp of what is going on the grounds. Now, I know there are guys out there who do it and they do a good job of it, but for us, we really want to be in the weeds with everything going on at the property level.
Yeah. And I think that's uber important. And I do the same thing. How many employees do you have on your property management company?
So right now we have, when we're fully staffed, so I'm not sure if we're fully staffed today or not, but when we're fully staffed, we're about 55 employees.
Wow. That is a big operation.
It's a big operation. So we have everything from, district managers, area managers, community managers, assistant community managers, maintenance guys, all the way from regional guys to lead make-ready guys, because I'll tell you, that's an important component of any park. Is if you have park-owned homes, you got to have make-ready guys who can know what they're doing. They can put the product back together if there's any turn. I think that's one of the things we found on the mom and pop type operators, or even the small regional type guys, is they miss that component of make-readies can eat your lunch. If you're not paying attention to it, if you're not putting them back in service as quick as possible, if you're not leasing them, it can turn a profitable park into an unprofitable park very, very quickly.
Yeah, no, I agree. Real quick, would you mind sharing a case study of something that, a negative case study and a positive case study? Break it down. Sure. Like what, maybe you had one park and some really bad struggles with that park. Maybe you can elaborate what those were, and then, share a good one as well, so we could see the opposite side of it.
Yeah, absolutely. So the very first deal we syndicated was a park in Missouri. We drove through the town. Town looked good. The park looked good. The sweet old lady who had managed it for the last 15 years for the out-of-state owner, everything looked exactly like it should. So we got into the deal. We found out post-closing that the manager had been titling a bunch of abandoned homes into her name. She had been running. So basically we had a partner we didn't realize we were going to have in the deal.
Jeez.
So we worked through that. Our biggest, that was our first deal. Our biggest mistake we made there was we structured it wrong. Meaning, first deal out of the box, friends, family, neighbors, everyone who invests with us, like, look, guys, we're going to give you the money, but if you can't make it work, we're not putting anything else in. So we didn't structure capital calls appropriately. And I can't emphasize that enough. Any syndicator, you don't want to be undercapitalized. You don't want to try and juice the returns by not raising enough money. You got to have the money because there's 100% of the time unexpected stuff. So that was our first deal. We structured it wrong. Over about a 6-year run, it was about an 80% return of equity. So we had a loss on that deal. It's the only deal we've had a loss on to date. And again, we structured things completely different. Now we've moved into the fund model, which is a much better structure. I think it spreads out risk. So that's kind of the bad deal we did. The very first deal. We have a couple of deals right now that we're working on refinances that we've done very well on. So we're talking a little bit about the value add, whether it's a rent increase, whether it's just a fill. So just, one of our properties, for example, is in Tulsa. It's 60 units. We bought it. I'm surprised the city hadn't condemned it. I mean, the streets looked like they had never been fixed, never been repaired. I mean, almost every home that was there was like halfway dilapidated. I mean, it was just a train wreck. So we bought the property. We spent about $200,000 on street works, the off street, the new asphalt. We put in 40 new homes. We leased up 40 new homes.
Wow.
So we took an asset that looked condemned and we basically 5x the value we paid for it over an 18 to 20 month period. So that's a challenge to do. That's a lot of heavy lifting. We have another deal here in Texas we bought. Same type of deal. It was extremely under market rent, but it was full. And that you can understand, the streets were in really rough shape. No one had done any repairs. So that the residents were okay living there because, hey, it's the cheapest rent in town. I don't mind driving down the streets and my, popping tires every week because everything's all jacked up. It didn't matter to them, right?
Yeah.
So we went in, we spent about $400,000 on street work.
Wow.
Increased the value, the rental rates to market rent. We over the last 14 months, we've just about got a 3x on valuation on that deal.
Wow.
So again, it's raising rents is easy, but doing the street work is not easy. As a principal, you got to be on site, making sure, hey, if you pay for 2 inches of asphalt, you're going to get 2 inches. They're not going to do just a thin enough layer where it looks good. You got to make sure that they, do the proper radius so you don't have pieces break off. I mean, it's a lot of work. And so that deal, obviously it turned really quick for us. The resident cleanup, we're still in the process of the resident cleanup right now, but I'm hopeful we'll be able to complete the cleanup without much loss of residents at that property.
Man, that's fantastic. See, those are the ones that give you the goosebumps, man. Because not only is it a win, as an investment, but also you made that community look better. It probably hadn't been touched for 20, 30 years, So
correct.
For you to be able to, fix that deferred maintenance, I'll never forget one resident in Salem, Ohio. One of my first communities, I literally moved with my wife and my daughter into the community. There was a house in front of this community. We moved into it for 3 months and we did a ton of work to it. One of the residents came up and literally was tearing up because she was like, I was embarrassed to live here for so long. I've lived here for 20 years, but now I feel good when I come home. It just that you can't beat that. That's the other side of the business that just it gives you the warm fuzzies.
And that's it. People come out, they're so appreciative that even taking rents to market, they don't care because they're not embarrassed anymore. We hired an assistant manager here recently of one of our properties, And it was a big turnaround deal. And I was talking to her last week and she said, I hated driving through this community. It was like the worst part of town. I was embarrassed to tell people I even drove through it. I don't even live here. And she's like, it's a totally different deal. It's a totally different deal. It's the analogy we use around here is when you're done with it, you clean it up, you fill it up, you do the CapEx. It's like giving bread to the hungry. I mean, residents are just so appreciative of it. And you're right, you can't beat it. I mean, it's a good feeling. It's a win all the way around.
Totally. Well, Skyler, thank you so much for taking the time to come and be interviewed on this podcast and for just adding value, to our listeners. If any of our listeners would like to get a hold of you, what is the best way for them to do so?
Yeah, so the best way is through email. My email address is Skyler, Skyler, at AmericanDreamCommunities.com. So that's kind of our investor-facing website. So there's more information about us there as well.
Awesome. Well, thanks again, Skyler. That's it for today's show. Thank you all so much for joining us.
Thanks, Andrew.
Would you like to see mobile home park value add projects in progress? If so, follow us on Instagram at Passive MHP Investing for photos and awesome videos from our recent mobile home park acquisitions. Once again, that's at Passive MHP Investing on Instagram. See you there.